Folks are making their way in.
Yep.
Don't be shy. You can sit in the front row. You don't have to sit all the way in the back, folks. It's okay. It's not church. No, I'm just kidding. Fun topic. Hopefully we can, we're fairly entertaining, Shannon. I think we can keep people awake despite how dense some of this stuff can be. So we'll have to keep it lively.
Yeah, we'll try our best anyway. Making RSUs come alive.
Yes, exactly. Hopefully nobody had a heavy lunch before this, a high carb lunch before this. Hopefully, definitely grab some caffeine before we get into the details. But no, just kidding.
And if you guys, as you're coming in, if you just want to put in the chat, if you have any particular questions or topics that you want us to cover, that will be helpful because we can just make sure that we cover everything that you might. Well, we're not going to cover everything, but at least we can cover the broad topics that you might have interest in.
Absolutely.
Okay, so I'm just gonna get started. I'm Shannon McNulty. I'm the founder of the Village Law Firm, where we focus on estate planning for New Yorkers and their families. And it's really interesting over the time I've been a New Yorker, just about 20 years, that when I first came here, there was not really any technology here at all. There was no tech companies here. And now it's one of the bigger sectors in the city, and there's a huge number of companies, of startups. We have Google, we have Facebook, we have Amazon, everything. So this has been, I guess, basically like a growing issue because equity compensation is very common in these industries, and so I thought it would be a great idea for John Owens from BrooklynFI to join us. He is a bit of an expert, a renowned expert in equity compensation and planning for clients. And I hope that will be helpful today. So, John, you want to introduce yourself?
Absolutely. Thank you, Shannon, for having me and for doing this talk. It is equity compensation is a complicated topic. There's a lot to it. We are not going to cover everything in an hour today, but I'm so glad to be here to talk about this. I'm the director of financial planning at BrooklynFI. BrooklynFI is a fee-only financial planning, investment management, and tax firm based in Brooklyn, New York, but serving clients across the country. I actually don't live in Brooklyn. I live in Pennsylvania. Shannon and I are both Pennsylvanians at heart, which is kind of a small world. But yeah, we work with over 300 households and help them navigate their financial planning, investment, and tax needs and deal with complicated equity situations all the time. So happy to talk about equity today, planning today, and also, Shannon, how it intersects with the work that you do, which is estate planning, and which is incredibly important for everybody, but very important for folks that have equity comp, especially equity comp that could be quite valuable.
Great. And I just want to let folks know that if they have questions as we're going along, you can feel free to just put them in the chat and we'll try to get to them as we go. Or you can save them to the end if you have anything that comes up. Okay, so first of all, this is not... There we go. We just want to kind of give an overview of the types of equity compensation, and this is a bit of an alphabet soup. So if you can give us the lay of the land, John, on what all of these things stand for,
yep.
And what people can make of when they get a job offer with RSUs or NSOs or ISOs or whatever. What does that actually mean?
Yeah. And so, looking at the different types of equity here, restricted stock unit, these are most commonly associated with folks that are working at an already public company or soon to be public company. And that means that, hey, I'm going to give you some share. You work at Google, let's say, you're going to get shares of Google, they actually call them Google stock units or GSUs because they're special. Basically giving somebody the promise of future shares of stock to retain talent, to give them a financial incentive to grow the company, to grow the value. Restricted stock is slightly different, actually kind of associated more so with the opposite end of the life cycle. Google's the mature public company that's been out there a long time. Restricted stock is often associated with a new company that maybe isn't worth anything, and then you're granted actual shares. So you have shares of the company subject to some restriction, typically called vesting, which we'll talk about a little bit later in the presentation. Non-qualified stock options are just a type of equity compensation that you have a little more discretion over in terms of when you exercise. These are common with both public companies and private companies. It really just depends on the size of the equity being granted and the equity plan. And then the one that we hear about a lot, because it is arguably the most complicated, is incentive stock options, or ISOs, that have some very unique tax characteristics and potentially some very solid tax advantages. We see these a lot for folks that are not necessarily the startup founders. Sometimes they are the founders, oftentimes the early stage employees at startups that have been the key drivers helping them grow, get closer to being a larger company and going public.
Great, and we'll go into each of these in a little bit more detail, but that's just an overview. And then a couple of other concepts that come up in this space are employee stock option plans and the concept of qualified small business stock. Can you just explain a little bit what each of those mean?
Absolutely. An employee stock purchase plan is typically associated with a public company, and it gives the employees an opportunity to buy their company stock at a discount. That discount could be up to 15%. And so, not a lot of things are on, you go to the grocery store these days, not a lot of things are on sale. The stock market's a little bit on sale at the moment. But, the opportunity to buy your company stock at a 15% discount, that's not bad. And then qualified small business stock, or QSBS, is, Shannon, you have a background in tax as well, arguably one of the biggest areas of the tax code for excluding income, and could allow folks who are early stage investors in startups or startup founders to potentially have $10 million in income tax-free. And I'll tell you what, there's no other parts of the tax code that do that. So it's a very unique opportunity for folks, and something that we often look for when folks have been early stage employees at startups and have held shares meeting some of the requirements. We'll talk a little bit more about the details behind that soon.
Great. Yeah, that's a huge benefit that a lot of people just don't even realize, and there can be a lot of planning opportunities around that.
Absolutely.
Okay, so restricted stock options, or RSUs. This is when you have generally it's a more mature company like a Google or a Facebook, and this is some kind of promise to give them stock, or explain a little bit about that.
Yeah, that's a great question. So what often happens is, let's say you get a job offer from Meta, Google, wherever it might be. They might say, hey, your salary is $250,000 a year, and we're going to grant you 1,000 shares of stock through restricted stock units. And what they're going to say is, maybe those shares will vest over 4 years. So 250 shares a year over 4 years. And so what happens is you get 250 shares on those annual days, basically on that anniversary, and you pay tax on them when they vest. Okay, and so let's say your vesting day's coming up, it's July 15th. You're going to have a funky looking paycheck on July 15th that shows, you got 250 shares, but 100 of them were withheld for taxes, and now 150 shares are being deposited into a brokerage account, typically at like an E-Trade, Morgan Stanley, Fidelity, Schwab, depending on which custodian manages the plan. But the incentive here is to say, hey, you're an employee of this tech company, whatever it might be. I want to give you incentive to deliver value, to grow the value of the firm, to grow the stock price. And I think the one thing that is really nice about restricted stock units is that they always have what we call intrinsic value. And so they're always, unless your company stock is worth zero, which in that case you're out of business, right? And you're looking for a new job and you're not really worried about your equity plan. Unless your company stock's worth zero, RSUs will always be worth something. There's a difference with options, because options are just the option to buy something at a certain price. Well, if the price that you can buy it at is higher than what it's selling at on the market, then that's not really worth anything to you. There's no discount involved. I would say there's one big trap with RSUs that people need to be mindful of. There's many traps potentially, but one big one, and that is that the tax withholding on RSUs is often inadequate. Most of the time, RSUs are withheld at 22% federal income tax, and most of the people that I know that have equity compensation in RSUs are in a much higher tax bracket than that. And so RSUs could be a tax surprise.
Okay, that's really important because you don't want to come April and then you have this enormous tax bill that you were unaware of. Maybe
Absolutely.
You don't
And I hear so often, the most common thing I hear is, well, they took taxes out of it. They did, they just didn't take out enough. And that's you got to be careful.
Okay, great to know. And are there any rules of the road in terms of, do you hold on to this? Do you sell it right away? What are I know some of these things that you have, it's better to hold it for a certain amount of time. What is the rules with respect to, or the advice with respect to RSUs?
If you have restricted stock units and you're working at a public company where you can, there's a market to sell into, and you have liquidity, there's really no incentive to hold on to RSUs after they vest. And so I like to think about it as, hey, RSUs are really a bonus. Okay. So instead of, let's say, Google gave me $25,000 in RSUs, Google gave me a $25,000 bonus, and I can invest that bonus anywhere I want. Am I going to put it back into Google stock where my income comes from, where I have other equity that's vesting in the future, or would I put it somewhere else? And so there's really no significant tax advantage to holding onto RSUs after they vest most of the time.
Okay, great. So that sounds pretty simple. Any other things that we need to be aware of with respect to RSUs that you want to share?
I would just say one thing to keep in mind in particular, we live in a time where folks have moved around a lot during COVID. I've moved 3 or 4 times during COVID. RSU vesting schedules and state taxes are very unique in that, let's say you lived in New York, you got granted RSUs a couple of years ago before COVID, then you decided, I'm out of the city, I'm going to move to Pennsylvania or somewhere else, maybe somewhere warmer like Texas. You may still have trailing tax obligations to New York. Ditto for California if you live in California. And so we need to be mindful of that and taxes with RSUs because there can be surprises there on the state level.
Okay, great advice. Okay, restricted stock.
Yes.
How is this different from RSUs?
I know. We had this conversation preparing for this call, Shannon. You're like, wait a minute, these sound similar, but they're not the same. Okay. And so with an RSU, all you have basically, with the prior example, which is an RSU, all you have basically is the promise of the company saying, like, if you're working here on July 15th still, and we didn't fire you and you didn't quit, we're going to give you 250 shares then. With restricted stock, you're kind of getting the shares up front. And so the company's saying, I'm giving you 10,000 shares of this subject to a restriction. And the restriction is typically that, like, you're going to continue to work here over the course of this vesting schedule. But you have the shares themselves. And this is most commonly associated with early stage startups. Maybe you're one of the first few employees. Maybe you're one of the co-founders. But I can't just give you your shares outright because I don't want you to, own a third of the company and be like, hey, I'm out. I'm not sticking around to do the work here, and I own a third of the company. And so what happens here and where the tax trap comes in with restricted stock is that as those shares vest, that becomes taxable. Okay. And so what we often want to think about with restricted stock is, hey, there's no liquidity here, right? This company's not public. So I can't really sell these shares to pay the tax on it. And so with restricted stock, we often look at something called an 83B election. And an 83B election is basically telling the IRS, say, hey, I got all this restricted stock that today is worth a penny a piece, okay? And I would like to pay tax on that 1 penny per share restricted stock today for my 10,000 shares. And it's a Thursday, so I'm not going to do the math. It'd be like $100, I guess. $100 in income to reflect, the tax associated with that. And I'm going to pay. I'll gladly put the extra $100 on my tax return and pay tax on it now, so that I don't have a surprise because maybe 2 years from now, when my shares vest, they're worth $35 a share, but the company's not public and I have to pay $35 a share tax on $35 a share in income when I can't even sell this to pay the tax on it. And so restricted stock is very important to consider an 83B election. And I think we talk a little bit more about 83B election a little later in this presentation, but certainly something that we need to be careful with because there are very strict rules about 83B. So if you're granted restricted stock, you need to talk to a tax professional and you got an equity professional to find out what the proper steps are and what makes sense for your situation.
Okay, and I want to go over, because not everybody may be familiar. I mean, usually most people are a little bit familiar that capital gains tax is better than other types of taxes, other rates of taxes, and say your salary. Can you a little bit explain more of what those rates actually look like and what are the rules for capital gains rates and ordinary, what we call in the tax industry, ordinary income rates?
Yeah, that's a great question. And so, to ordinary income tax rates go anywhere from currently about 10% all the way up to 37% on the federal level, since the tax cuts were passed at the end of 2017. Capital gains rates, the top capital gains rate in the United States currently is 20% for assets. Now, that's a little bit illusory because there's something called the net investment income tax that's one of the Obamacare taxes. That's another 3.8%. And so really the top capital gains rate's about 23.8. But would you rather pay tax at 23.8% or 37% is the question. And so by planning ahead, you can potentially lower your tax bill. But I think the big caveat that comes with that, Shannon, is that planning ahead and being proactive requires taking risk and being mindful of the fact that I may buy shares to start the clock for capital gains and to set myself up for long-term tax success. But what if my startup doesn't raise funding the next round? And what if we go under? What if we don't, what if things don't pan out? And so it's obviously weighing these various tax considerations and your other goals that's so important.
Yeah, okay. And we'll circle back to this, I think, on the 83B election when we talk about that. So the RSUs are taxed as ordinary income, right? There's nothing we can really do about those. We get them and they're just almost like money. They're just like,
correct. Yeah, it's just
writing a
except
check.
you're
It's
getting
just in the form of
shares.
stock.
You're just getting shares of stock. And so when your RSUs vest, they are taxed as ordinary income. There's no discretion there. To the question that was asked, dropped in the chat, I think that one thing to keep in mind is that people think about RSUs and say, well, if I hold them for a year, then I'll get taxed on capital gains. Okay, that's only on the appreciation above the price that they were at when they vested. And so if you were to sell that Google stock in my example and go invest hypothetically in the S&P 500 and hold on for a year, you would also be taxed at capital gains on any appreciation there. And so the question becomes, there are literally thousands of things you can invest in. Does it make sense to continue to keep it in Google stock because that's just how you happen to receive it?
Right. It's not going to change the eventual tax consequences. Correct. If you sell it or not at that point. Okay, great. That was really helpful. So non-qualified stock options or NSOs.
Yes. And so with non-qualified stock options, a little bit different than RSUs as there's more discretion on your part as somebody who's been granted these as to when you want to actually have the income. And so, the RSUs, it's July 15th, they vested, the income's now. Restricted stock, it's been 2 years, they vested, I've got to pay tax on this unless I filed an 83B election. With non-qualified options, remember, I have the option to buy the stock. And so what normally happens, how non-qualified options work is, let's say, we've got John and Shannon Incorporated. We hire somebody to come work for us. And let's say the stock price when they're hired is $1 a share. Okay. And so we say, hey, I'm going to give you the option to buy 10,000 shares of John and Shannon Inc. For $1 a share. And you have 10 years to exercise this option, to go ahead and buy these shares. Well, you sit there for a couple, you're like, well, I'm a new hire at John and Shannon Incorporated. I don't know if I really want to work for John, but I'll give it a shot, right? And so, 3 years later, the stock for John and Shannon Incorporated is worth $30 a share. We've grown a lot. We've raised money. Maybe we go public. And so now you have the option to pay $1 a share for a stock that is worth $30 a share. That's a pretty good deal. I'll take it, right? And so what happens, oh, sorry, Shannon, you're muted.
Because I muted myself because there was construction going on outside, but it's like money in the bank, pretty much. Like, right?
Yes, exactly.
If I could buy a stock that I could sell tomorrow
right away
for $50 and I could buy it at $25, that's basically like having $25 in the bank.
Correct. And so, but remember, it's only, that stock price can very easily drop, as we've learned the last few months, can very easily drop back down from 50 to 25 or 23 and not be worth anything. And so with non-qualified options, you have this degree of discretion around, okay, hey, the price is at 30, I could buy for 1. I'm gladly going to take and bank that $29 difference. You're also going to pay tax on that $29 difference at ordinary income tax rates. Those rates that I said earlier stop at 37% plus state taxes on top of that as well, of course.
So it's $29 in the bank plus, minus the,
potentially 50% in taxes
that you have to escrow for tax.
Correct. And typically they withhold some of the taxes upon the exercise of non-qualified options. And so really when you think about non-qualified options, it's really a question of how do I want to unwind this? Do I want to take a less risky strategy of selling sooner, getting money out as soon as I can? Or do I want to take a more risky strategy of potentially spreading that tax burden over more years and having less of a cumulative tax bill, but understanding that there's risk that maybe in 5 years the price is much lower? I think we live in this area of like, hey, like I work at a tech company, we do great things. Like, why would the stock price be lower in 5 years? Well, what if you're MySpace? You know what I mean? What if you make VCRs, the VCRs of the 2020s? I don't know what the VCR of the 2020 is, but you might be making it, and that's the risk. And so how do we unwind strategically and in line with your goals?
Yeah, I think that this is one of the hardest in terms of strategizing, because you really are, generally there is going to be some value there that you maybe want to exercise, but that means that you're getting taxed now and maybe the stock goes down later on.
Exactly. Yeah. And so I think one of the big drivers of this is why people don't sometimes exercise their non-qualified options and exercise and sell them, I should say, is FOMO, fear of missing out. Well, what if it's higher later? What all that. And that's why it's so important to have a plan to say like, hey, like, guess what? You might be able to achieve the goals that you set out by selling at that $30 a share. You don't need the stock to be worth 60 to get where you want to go. And I think that's helpful. I like to use the analogy of like, if you're going on vacation and you can get there on time, driving 60 miles an hour, why would you drive 90? It doesn't make sense. You have a higher likelihood of hurting yourself.
So when we exercise the option, that $29 in the bank, that's taxed like ordinary income, right?
Correct. Yep. It should show up in a pay stub, show up on your W-2. And then again, if you were to hypothetically hold on to the shares, okay, so that is something you could do, your cost basis would be $30 a share, which is the dollar you paid to buy the shares plus the 29 that was in your wages. And then any appreciation above $30 a share would be capital gains, short-term or long-term, depending on how long you hold it.
So if you really thought that this company was going to do very well, it might be best to exercise those options and then hold on to them for a year.
Potentially. That typically only makes sense, though, when you are when you're facing expiration. And so let's say your options might have a 5-year window before they expire, a 10-year window before you expire. And so, or if your company's not public yet and there's no market to sell into, and so you need to make a decision on acquisition. But the risk you want to keep in mind is that if you are at a public company and you are not, facing an immediate expiration of your options, it's actually going to cost you money, not diversified money, to pay the taxes and to buy the shares, to then hold the asset on the speculation that it's going to continue to appreciate. If that's the case, you might want to just hold off on exercising, and with the thought that it might be higher later. But again, it really should be driven by your goals.
Yeah. Okay. Yeah, and I think that that's a really good point, is whether this is a public company or not, and what the market is for resale. has a really big effect on where, if you want to exercise those options or not, because can you sell them otherwise, or you're going
Yeah.
to hold on to
And I
them,
think
right?
one
So if you
situation
exercise it, you're not really getting that money in the bank, because you've bought this stock, but you haven't
exactly.
sold it and you can't sell it. So you're
Mhm.
paying for something that you can't really benefit from for a while,
Exactly.
and
Or
maybe
you might
not
never
ever.
benefit. Yeah. And I think so
Yeah.
that's a situation I encounter quite a bit, Shannon, which is somebody calls me up and says, hey, I'm leaving my job. I'm at this tech startup. I'm going to work at a more traditional tech place like Google or something. And I'm worried. I have this equity. I believe in the company's long-term thing, but I've got 90 days to figure out what to do with it. And so we need to basically look at, are there lending options? There are some companies that will actually lend you money to exercise your options and pay the tax bill, and then they participate in the upside. Or it's coming up with a budget and saying, hey, how much of your other money do we want to kind of roll the dice with here and risk in terms of taking this, knowing that it could be worth nothing at some point. So yeah,
Yeah.
always a tricky conversation.
Okay, so non-qualified stock options, that's a tricky one. You definitely want to get some help and advice on what is the best strategy for you. Okay, ISOs, what do we have here?
Yeah. So incentive stock options, if we thought the last three types of equity that we talked about were complicated, then buckle up and sit down for this one, because ISOs, incentive stock options, are arguably the most complicated type of equity. So they are very similar to non-qualified options in that, basically, using my same example, we hire somebody at John and Shannon Incorporated, we give them the option to buy at $1 a share, um, you know, uh, similar vesting schedules, that sort of thing. But there's potentially a really tax advantaged outcome here, which is that in the prior example, if the price is $30 a share and your exercise price, the price you pay is $1 a share, you had $29 that shows up in your pay stub that's taxed as ordinary income. With incentive stock options, that is not the case. Exercising incentive stock options and holding them, so paying that $1 per share, doesn't trigger any additional ordinary income taxes. But it does potentially trigger AMT, or the alternative minimum tax. I wish we had sound effects like, ooh, what is the alternative minimum tax? Yes. The old joke is, the old tax joke, Shannon, is, I don't want to pay regular taxes. I'll just pay the alternative minimum tax. Who wants to pay more than the minimum? But that's not really how it works. And so with that is, I'm just going to do a brief overview of AMT. I don't want to get too technical here, but it's basically a parallel tax system next to the regular tax system that is different rates, that is different deductions, and different things that they use to calculate income. Now, the reason why the AMT exists is because back in like the 50s and the 60s, Kennedy was president, there were these really wealthy people that made tons of money, but there were so many deductions and loopholes in tax code that they didn't pay anything in tax. So they created the AMT to try to make it so that, these people did pay something in tax. Nowadays, I think I heard, I was at a conference a couple weeks ago, I think there's only about 100,000 folks or so that paid AMT in one of the last few tax years. It's very rare. And I was like, well, about 1% of them are our clients, I feel like sometimes. Not that high, but it seems like it. But basically, the AMT basically is a different tax that you might have to pay when you exercise incentive stock options. And so we need to be very careful about when we exercise. Now, the good news is this, okay? Using that same example, $1 a share, now we're 30. You exercise, $29 a share is your discount, okay? You go ahead and sell those shares more than a year after exercise and more than 2 years from when the shares were granted, then you are in a spot where that $29 is taxed as capital gains and not as ordinary income. And so that's where you potentially get the discount of about 14, 15%, 23.8% versus 37% for ordinary income. But understanding what your AMT bill will look like and how much you're going to pay and when you will potentially get that AMT money back in the form of a credit is really important, because there's risk that you pay so much in AMT and it'll take you many years to get it back that the federal government, that it's not really worth it to go ahead and exercise and hold incentive stock options. And so, it's very tricky.
Okay. Yeah, that sounds like so. So here you can actually exercise. You don't get any tax on the exercise. You only get taxed and potentially at long-term capital gains taxes when you sell. Is that right?
But you may pay AMT. And so
Or AMT, the higher of the two.
The AMT would be due the year you exercised. And so the risk here is that,
okay.
Yep. So that's going to show up on your tax return the year you exercise your ISOs. And this is something I see all the time where folks they have ISOs, they exercise, they don't really understand that. They did their tax return in TurboTax. They didn't know what this was. They threw it off to the side. And so their exercises that get missed, they don't pay the right amount of AMT. And so we need to be very careful. The good news is all the money you pay in AMT, you get, in theory, you get back in the form of a credit in the future. So that is money that we can eventually earn back, but it's really a question of the timeline.
Okay. So it's really, I feel like you have to run the numbers on a lot of these things
absolutely,
to actually figure out for each taxpayer what makes the most sense.
Exactly. And you need to basically set a budget for, okay, hey, how much am I willing to spend in AMT? Am I willing to roll the dice on a $50,000 AMT bill because of, knowing that you might lose that money or the stock might not be worth anything at some point?
Okay. And I just wanted, there's a question, something about a 6-month holding period. Is
Correct.
it something that you're able to address?
So RSUs, the question has to do with Rule 144, which is a securities law in terms of restricted stock. Okay, and I think stock that is restricted under securities law often has to do with folks that acquired it, the shares that were unregistered, folks that were early stage investors, that are reporters because they're high-level executives at companies. Truly, like restricted stock units, because you work at Google and you're an engineer there, or you're a VP of human resources, often not something we need to worry about with Rule 144. I guess what I would say is if you're subject to Rule 144, most of the time you're well aware of it. Most of the time company counsel's talking to you about that, and there's legal teams involved making sure that you stay compliant and report correctly.
Okay, great. Next we have
a little bit more on ISOs, but I think we've kind of talked through most of this. They have unique tax treatments, but potentially a lot of upside.
Okay. Employee stock purchase plans.
Yes, the ESPP. Yep, you see this at a lot of public companies. You're typically able to buy the company stock at a 15% discount. Contributions are after tax, so you're not getting any benefit, or deductions from your pay. It's just money that's going into this plan. But with an ESPP, there's potentially an opportunity to buy stock at a 15% discount and then sell it very quickly after you get it to basically just lock in that profit of about 15%. You'll pay tax on that 15% discount, but still, it's the potential for free money. There is risk involved. Where these can be really valuable is when there's something called a look-back feature. And so normally there's maybe a 2-year offering period for an ESPP. And what can happen is it can say, hey, you get to buy at a 15% discount at the lesser of the current price, or the price at the end of the window, or the price at the start of the window. Okay, so if you take a company that 2 years ago was trading at $10 a share and is now trading at $50 a share, you might be able to, at the end of this window, buy at a 15% discount off the $10 a share price. And so pay $8.50 for a stock that's trading at $50 a share. That's a really nice deal. You need to be careful and watch out for lockup restrictions, provisions, and sale restrictions. These are things that would say you actually need to hold the stock for 6 months after you buy it, or for a year after you buy it, or maybe it's not going to line up with one of your trading windows in terms of when you can sell. And so those are kind of the landmines that are hanging out there with ESPP. But oftentimes, if you have the cash flow, this is a great way. Relatively low risk. You could lose money in this, though, but a great way to potentially get some more value out of your company.
Okay. Great. Qualified small business stock. As you said, this is kind of like the $10 million boondoggle.
Yes, exactly. And there aren't many $10 million boondoggles in the tax code, or else I'd be on a warm beach right now, or something like that. Although it is pretty nice here. So also known as Section 1202, qualified small business stock potentially allows you to exclude up to $10 million or 10 times your investment from income if that comes from an investment in a qualified small business. And so often think about like early stage startup employees, who exercised their incentive stock options or who were granted restricted stock. They've held the shares for more than 5 years. They have the right, it's the right type of company. There's actually some business sector rules that are tied to this too. And so you might say, oh, I invested more than 5 years ago. The assets of the company were less than 50 million when I invested in it. I've held it for 5 years, but there's even more minutia in terms of the Internal Revenue Code is like, hey, this is a qualifying business and this business type is not. And so we need to be careful with that. And so oftentimes when there's something like this going on, we've seen two different scenarios. Sometimes the company puts out guidance to say, hey, we believe we're qualified small business stock because of X, Y, and Z. If you bought the shares before April 1st of 2017, you should be eligible. We believe the company meets the requirements for this. You need to determine on your own whether you meet the 5-year holding requirement, some of the other stuff. Sometimes it's not that clear. And when it isn't clear, and you're potentially excluding millions of dollars from your income, then you want to go out and actually get the opinion of a tax attorney who deals with this all the time. And they might charge you, $20,000, $30,000 to write an opinion letter about your company stock and your position to say, you can exclude it or you can't. But the nice thing about that is then you've shifted your risk. You now have a professional who has given you an opinion, and you can say, great, I'm leaning on this opinion to exclude $10 million from my income and file my tax return. And that should help you at least if the IRS comes back and says, no, we disagree, in terms of you had a reasonable basis for making that claim. And so very complicated, but something we look for all the time when folks have held stocks and their companies have grown a lot and trying to kind of determine whether they might be eligible for QSBS.
And just an FYI, even if your lawyer ended up being wrong, you're still liable for the tax.
You still have to pay the tax. You just might avoid some penalties.
Just avoid penalties.
Yeah.
So it's not a get out of jail free.
It's not get out of jail free,
but it's not get out of the tax bill free.
Yes, exactly. Just to be clear. Good point.
Okay.
Shannon's like, I got to look out for the tax lawyers out there, your former classmates, right?
Yeah. Well, I feel like people they just don't realize it, and that it's really it's unfortunate, but even the IRS is not going to just accept like, oh, my lawyer or my accountant or whoever told me that I don't have to pay taxes, so I don't. They're going to say, well, that's really nice, but you need to go get a new lawyer.
Exactly.
Okay, so back to the 83B election, and this is, you have to exercise or make this election on to the IRS within 30 days of the grant date, and this is the election to have it taxed before vesting, right?
Correct. And so with an 83B election, you're basically saying, hey, I got granted a bunch of shares of restricted stock. They're going to vest over the next 4 years. I have no idea what they're going to be worth later, but right now they're worth $100 when you add them all up. And so I will gladly pay tax on $100 today. Please include this in my income. Count my holding period starting today for long-term capital gains, which is also a nice thing, and do this. But you need to elect within 30 days of being granted restricted stock and file this with the IRS. You want to send this through certified mail. We've actually got an article on the BrooklynFI website about how to properly file an 83B election if you ever need that. And so that's really important. When you do 83B with options, you cannot 83B an option, okay? But you can do what's called an early exercise of a stock option. So if your equity plan allows it, and then file an 83B election on the shares that you get. And so that's a strategy. Sometimes maybe you weren't granted restricted stock, but you're granted incentive stock options at a company. They're not really worth much at this point. You want to do what's called an early, you might potentially want to do an early exercise, file an 83B election, and that'll allow you to start the clock as well on that. It can be very tricky. One thing I've seen, I'm going to write a blog post one of these days, Shannon, about like equity horror stories, I'm going to call it. Maybe by Halloween I'll have it done, but just things that I've seen that I just, I've dropped the phone out of my hand because I couldn't believe it. 83B often really only makes sense for folks that are really early stage, that aren't going to produce a big tax bill because of it. And because of, if we remember some of the timelines associated with equity compensation, and like the 2-year holding period for ISOs and those sorts of things, filing 83B at the wrong time when you generate a big tax bill, but you might not be able to sell the shares yet, could be financial disaster. And so you just want to be very, very careful when you're making these considerations.
Okay, great. And it's really important, I believe, to make it within that 30 days, right?
Oh yeah,
Like there's
they're
no
not
going
going to be,
back after
no,
that,
no.
from what I understand.
Yeah.
Okay.
And I've
And
seen what
that,
happens when you have restricted stock and you don't file an 83B election, and then every year we're sitting around like this tax bomb's going to explode. And what is that going to look like?
yeah, so this is really could be a big game changer in terms of, you could end up selling or saving or losing millions of dollars based on this.
Correct.
And just to reiterate, when you make that 83B election, you're paying ordinary income tax rates, but on a very small amount, ideally,
Yep. Yes,
right?
ideally.
And then once you sell the stock in the future, then you get long-term capital gains as long as it's been for over a year.
Correct.
And that's really, really that difference.
Absolutely.
Okay, making it through here. Okay, investing, is there anything you want to share about this?
Just to kind of highlight, this is how vesting works. So 5,000 shares over 4 years, how you accumulate shares over that time period is typically how vesting works. I maybe we should have let off with this because we talked about vesting a lot, but I think, just so folks have this context.
Yeah, so that basically means, right, like if you leave after year 2, you can leave with the 2,500 shares, but you're not going to get the rest
You're
of
not going to get the other 2,500.
Okay, what's the, in theory, caveat?
If you were fired for cause, potentially there are things like that could cause you to forfeit some of your equity. So don't get fired for cause.
Okay, good to know.
Just general advice there: don't get fired for cause. Generally speaking, whether you have equity or not, right? Yeah, Shannon, I think one of the things I run into, and the biggest hurdle we see in equity compensation, aside from some of the technical issues, folks like just don't understand their equity and don't necessarily have a plan, and that's what we spend a lot of time doing, building that plan, is that there are these behavioral biases that can cause us to make poor decisions at times. I think BrooklynFI is a wonderful place to work. I'm biased, you know what I mean? I like it, I'm one of the leaders of the firm, you know what I mean? Of course I think it's wonderful. Shannon, you think the Village Law Firm is a wonderful place to work, right? We are biased. We care about the companies that we work for. People feel this way all the time about their tech company or their startup. And so we need to kind of, divorce ourselves from some of those biases that we have and not get caught up in thinking about hindsight, not get caught up in thinking like, no, I know the stock's going to keep going up because I work here and we're going to be wonderful and all that. But yes, but what if it's 2000 and you make VCRs, right? We've got a problem then. You just don't know it yet. Or if it's 2004 and you make Blu-ray disc players, because nobody has one of those anymore either.
Or even it's an entertainment company and there's a pandemic, right? There's
exactly.
other things that like have nothing to do with the company that can just destroy, that just are outside forces,
Absolutely.
right? There's some kind of natural disaster or something like that.
Your WeWork, okay? I think it's really important to keep in mind that diversification is really the way that we reduce risk, increase returns over the long term, and that there is a smoother ride. And so I like to say the only way we never get the best price and we never get the worst price is to always be selling, to build a detailed trading plan, to always be strategically unwinding your equity as opposed to getting out all at one time. That's how we kind of minimize the FOMO that comes with hitting that sell button.
Yes, and you then, as long as you've hired somebody to give you that advice, then when the stock goes up and you say, "Oh, I should have held on to it," then you could just blame John.
Oh yeah. And I can pull my examples of just about every tech company over the last 6 months to say this is why we still sell. So yes, I've got plenty of war stories.
Yeah, that's actually why my dad hired an advisor, because he was like, at least this way you can't blame me if like I lose all the money.
Fair enough.
Okay.
Yeah, I think we've talked about a lot of these, Shannon, but just to kind of do a quick high level review of like how we think about planning around the different types of equity that we touched on here today. ISOs, we're looking for that holding period. So 2 years from exercise, 2 years from grant, 1 year from exercise. And being mindful that sometimes we don't even want to do that. Sometimes we just want to pay regular tax on ISOs because there could be a really big AMT bill. RSUs, as we said, there's no real tax benefit to holding it after they vest. Non-qualified stock options, the real strategy is to set up when are we going to sell them? When are we going to exercise? When are we going to sell? And we need to be prepared to pay a bunch in taxes regardless. We want to, also be mindful of, price floors and price ceilings as well. I don't really want to sell if it goes below this price, or I really want to sell more if it goes over this price, and to kind of game those out. So just some of the considerations that we like to have in mind.
Sure. And I'm just going to put in a little pitch that these are pretty complicated rules, and having an advisor who understands all of them and the pitfalls can really be helpful and valuable. So this is something I think that it's well worth it to hire somebody who does this professionally.
Absolutely.
And then just a couple of words about estate planning. You want to understand, so a lot of times, you'll have this vesting schedule maybe, and different companies have different rules as to what happens. So there might be rules, well, if you get fired, you're not going to end up with any stock. Or if you just leave and go to another place to work because you get a better offer, then you're not going to get anything over, anything other than what you've already vested in. But a lot of times people don't look at, well, what if I died actually while I was working there? Or what if I became disabled? And obviously things nobody really wants to think about, but it is important because sometimes this really represents a large portion of your family's wealth, and what they would be relying on if something happened to you. Go ahead, John.
I've got a client, Shannon. I saw something. Thankfully, nothing happened, but we were looking at this. The client works for a big tech company, has a few $1 million in RSUs vesting over a year due to a company acquisition, and those RSUs are really key to this client's financial plan. And their spouse does not make nearly as much money as they do. And one of the things we had to look at as part of the plan was, hey, like, if something happens to you, what happens? Does your wife still get all of these RSUs? And it's like, she does, up to a cap, up to $500,000 of a potentially $5 million RSU grant. So thankfully, we were able to kind of run the numbers, and they were adequately insured if that were to happen. But could be a very big surprise if $5 million in income all of a sudden disappears that we thought we were going to have over a few years.
Yeah, and also the other thing to keep in mind is that even if your stock is not liquid, that doesn't mean it's not worth anything. Mm-hmm. And this is a problem that I see a lot, is say, well, I have the stock, but it's not really, I founded the company, and so I don't really feel like it's worth anything because I just feel like, well, who knows what we're going to make next year, or who knows what the value is. And you could end up, and I have clients like this, and they end up there, well, they sold the company for $50 million. Well, they didn't think it was worth anything, but now a huge sort of opportunity for planning was missed. So, so we do want to kind of just keep in mind that even though, and also, if you passed away and you still had that company and it's sold after, which hopefully it will be because you want your family to have something, that the IRS is not going to say, well, that wasn't worth anything just because you didn't think it was. Mm-hmm. They're going to say, well, it was worth the $50 million. And we know because it was sold for $50 million, right? And even if it wasn't sold for $50 million, they may still make the argument that it was worth $50 million. So they are going to tax your family on the $50 million, not on what you think it's worth. And so there could be a lot of issues with liquidity, with just that big tax bill that they have to pay. And so that's something you just really want to keep in mind. And going to that end, when you're doing estate tax planning, there is a lot of benefit to planning early. And the reason is that we all have this, every American has an estate tax exemption, which is like basically a lifetime exemption. You can think of it as it's like a gift and estate tax exemption. Right now, that exemption amount is around $12 million. We expect in a couple years, basically, if nothing happens, it's going to go down to $6 million. Who knows? It may go down lower. Who knows? Because it all just depends on what's going on in Washington. But right now we are advising clients around the $6 million mark. One, because in New York, that's the amount. We don't have a $12 million exemption in New York. We only have a $6 million exemption. And two, because as the law is written, at the end of 2025, it is going to go down to $6 million. And most clients, especially if you have equity compensation, we're expecting you to live past 2025. So the way this, we'll just use an example that you do have a $6 million exemption. The way that it works is that anytime you gift money during your life, that exemption goes down. So I can give up to the $6 million exemption either during my life or upon my death, but anything I give away during my life is going to reduce that amount. So you might say, well, why would I give away anything during my life? The reason is that you're leveraging the value differential. So if you have, especially when you have stock that's going to go up a lot in value. So say I have $1 million of stock today, that's going to be worth $50 million in 5 years. Then if I even just take off half of that and I give it to a trust for my kids or my family, then that's saving, then I'm only using $500,000 of my exemption, but I'm getting out $25 million of assets that is basically going to be tax free. So that's what we do in terms of leveraging the early valuations when we're doing estate tax planning. There's a lot of different structures that we use, but just I think that what's really important to understand is just that there are opportunities for planning, and you do want to be aware of sort of that potential tax bill in the future. So you might even just want to give away a little bit just to take advantage of that leverage. And of course, we don't ever advise that without you having a solid financial plan, ideally with a professional, to make sure that you're not going to use the money. You're not going to need the money.
Yeah. To give away 6, you need to have a lot more than 6, right? You know, that's the key, Shannon.
Absolutely. Yeah, absolutely. I always say this is like, this is just icing, you know, like this is just, you're totally set for your life. And this is just, you're not ever going to use this money. You really want it for your legacy, for legacy planning for your kids, or for other people in your life. So that is really important. And then also just in terms of where this is going to end up. Is it going to end up having to go through probate? Can we transfer the stock into a living trust to avoid the court system? Because that could end up getting, right now we're looking at a backlog of over a year. So your family wouldn't be able to access that stock for a year. And that's frozen during that time, meaning that, well, if that stock starts going down, then they can't do anything about it. They're basically subject to the vagaries of the market. So it is important, especially if you do have a lot of things that could be volatile, that you want to have a plan in place to avoid probate, so to make sure that that value can be appreciated and taken advantage of by your family. Okay, so I think that's it. Anything else, John, that you wanted to add before?
No, I mean, I would just say last call for questions if anybody has anything that we didn't touch on, and happy to, if you want to drop them in the chat or in the Q&A here quickly. But I think we've covered a lot of ground here, Shannon. I think you know, the takeaway here is that equity compensation is complicated. It's potentially one of the most valuable assets that you have, if you have it, and that taking prudent moves to understand how equity compensation aligns with the goals that you have, which should be the most important factor, your tax situation and financial life, and your estate planning situation is really important. And the best way to do that is to partner with professionals like you, Shannon, to handle some of the estate stuff, to talk to a team like us at BrooklynFI about how to handle the taxes, the investments, the planning around it, so that you make smart moves. It's amazing. I read that, I'll leave you with this fact. I think it's about 15% of equity expires in the money without being exercised. And so people literally leave money on the table, do not exercise options that are worth something, and they expire. And I've seen it happen on a couple of occasions, unfortunately. And it's really kind of sad. It's free money essentially for some folks, or money that they've earned, I would say, that they didn't capitalize on. And so being prudent, making smart moves, getting a plan in place is crucial.
Right. Absolutely. I agree with that. And also, I'll add in terms of as well, it's really important to have a power of attorney too, because if you were in the hospital and say you're, during COVID times, we had people who were on respirators and they ended up hopefully being fine, but you might miss that 83B election period. You don't have somebody who can authorize it for you. So if you don't have that legal power of attorney in place, then you can kind of miss some of these deadlines or miss taking advantage and making the right financial moves that are important for you.
Absolutely.
Okay, well, thank you so much, John, for joining us. Thank you for everyone who joined us as well, and keep a lookout for our future programs.
Thank you, Shannon. Thank you so much for having me. Always a pleasure.
Okay. Great to have you, John.